Hey guys, we're going to analyze Meta, and by the end of the video, we're going to show you what we think you should pay for Meta based on our assumptions using our stock analyzer tool. So, Meta's Facebook, they're reporting this week. They got hit really hard in the last year. Very difficult. They hit a peak of 380 and have fallen really hard, over 50%. So, immediately as a value investor, I think to myself, okay, let's see if there's a mispricing here. Because my goal is to find mispricings in the market and where people assume there's going to be a lot of growth that now have been tailored back because they didn't hit their user growth numbers. But remember, the world is still young. They have almost 3.5 billion people using all of their products, and the world is still growing. We're going to hit 8 billion people here soon. And the next 5 or 6 years, we're going to have over 4.5 to 5 billion people using social media. So let's get right into it. If you belong to our software already, please obviously open Meta because it's a really good way of practicing how you look at stocks if you follow along in the video. If you don't have our software, more on that later. So, like I told you guys, look at the 1-year chart. 384 peak, hit a low of 154, and the stock is currently at 175. So, let's go through our 8-pillar process. Pillar number 1, we want the 5-year PE to be less than 22.5. So on the main page, we have it right here, 18.44, check mark, which means before it was almost 40 based on where the stock was before. Pillar number 2, we want the 5-year return on invested capital to be greater than 9%. So again, on this main page, 5-year return on invested capital, 16.3%. Awesome. It means they do a really good job of investing the money reinvesting the money that's in the business, getting a return on the money that's in the business. Pillar number 3, very simple. We just want revenue growth. I don't care what percentage, I just want revenue growth. So we go to the income statement in our software and we just go 5 years ago, 43.88, last year, 120 billion. Pretty awesome. Pillar number 4, we want net income growth over the last 5 years. So we just scroll down just a little bit on our software. Net income line, 17.86, 37.34, doubling up over there. Awesome. Now, pillar number 5, I want to explain. This is the silent killer in investing. So many people ignore this metric. We want to make sure they're not diluting you as a shareholder. Okay, what that means is if a company has 10 shares outstanding and you own 1, you own 10% of the business. But if they need to raise capital by issuing 2 more shares, there's now 12 shares in the business, but you still only own 1. But instead of owning 10% of the business now, you own 8.33% because it's 1 of 12 shares. So you're splitting all the revenue and profit up with more owners. We want to avoid that. So we scroll to the bottom of the income statement and we go back to the 6th year, 2.89 billion, and last year, 2.73 billion. So they do have less shares outstanding. So that's great. Now, pillar number 6 actually has to do with long-term liabilities. So debt works for a company the way it works for you as a person. If you and your neighbor are exactly the same people, same income, same house, same family, same everything, but you have 0 debt and they have $10 million in debt, who's going to have more trouble financially if something bad happens? It's obvious, right? It's going to be them. Same thing with a company. So how do we manage that? Well, what I do is we go back to the main page in our software. And by the way, if this math is confusing for you, don't worry. We've got a tab that does all the math for you in our software. I'm trying to explain the process right now so you learn. We go to our 5-year average free cash flow, 24.3 billion. We multiply it by 5. That's $126.5 billion. So we want their long-term liabilities to be under $126.5 billion. I got that wrong. No, it's 121.5 billion. Bottom line, it's called 120 billion. We go to the balance sheet, scroll all the way to the bottom. Total long-term liabilities, 20 billion. Check, 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 check. Here's even better, guys. Their total current assets are $59 billion, essentially the cash they have on hand. Their entire liabilities is 41. So they can write a check, pay off every debt in the company, and still have $20 billion left over. That's how good their balance sheet is. This is awesome. Pillars 7 and 8 have to do with free cash flow. So what is free cash flow? I'm sure you've heard this term before, and you're probably like, I don't know what that means. I don't blame you. I didn't learn it till later on in my life. Free cash flow is cash from operations less your capital expenditures. A company can do one of 5 things with free cash flow: buy back shares, pay down debt, reinvest in yourself, make acquisitions, and pay dividends. They can do all 5, none of them, any combination they want. So how do we calculate it? We go to our cash flow statement here on our software. Now, luckily for you, me as your loving Uncle Paul has added this line to the cash flow statement to make the math easy for you. 5 years ago, 18.74. Last year, 40 billion. That's a check mark. So they have growing free cash flow. And our final metric is we want to use the free cash flow as a way of looking at the company's value, just like we look at PE. So we take the 5-year average free cash flow of 24.3. We multiply it by the same 22.5 that we had for PE. And that's roughly, call it $500 billion. I'm not going to do the math fully, but it's $500 billion more or less. It's a little bit more than that. So we want the market cap to be under 500 billion. So we go back to the main page, and the market cap here is 477. So check mark there. Guys, if we have any X's, bam, 8 pilla thrilla. Everything is a check mark. Does this mean you buy the company? No. If this is your first time watching the channel, I'm Paul. I'm a value investor. I'm trying to teach everybody out there who wants to learn that buying a stock is buying a business and buying a future stream of free cash flow. That is my goal, or any cash flow. That is my goal here. You can overpay for growth, and that's my goal here is to teach you. You can overpay for anything in the world. You can overpay for a good thing, and you can underpay for a bad thing. That is the goal here, to learn that. So if you like all the software I've done here, we created the software because our users requested it. When we first started this channel 2.5 years ago, I was using an Excel sheet with my own data feed, and everyone would say to me, how do I get your Excel sheet? So we created the software. And since then, over 13,000 people have signed up. There are thousands of people every day in our chat. This is the biggest thing. Not only in this software do you get 30 years of financial data, all the financial statements you saw, all those tools, the stock analyzer tool, which you'll see next, but you also get this community of thousands of people who are active daily talking about every investment out there that you can think of. There's even a crypto chat in here, and I don't even believe in crypto. Anything you want to talk about, you can search Meta, go right to the chat that has it, and discuss your thoughts on Meta and get everybody else's input. This is a no-brainer, guys. This will make your financial future so much better just by being around like-minded people who think the same way. It's a good support team, because the hardest thing out there is when you see stocks falling, to stay with it and say, we are learning that if our fundamental beliefs are true still, we keep buying. That is one of the hardest parts about investing. Investing isn't about the numbers only. It's about the inner workings of the emotional side. That's what you get here. This is all available for less than a cup of coffee per day. 2 ways to sign up: everythingmoney.com or patreon.com/everythingmoney for our international users. But again, guys, this could, if you just get 1 or 2% extra return a year, or save 1 or 2% a year in losses, this will lead to hundreds of thousands, if not millions of dollars extra for you in retirement. This is a no-brainer. But now let's get back to Meta and what we pay for it. So let's go to our stock analyzer tool. So in our stock analyzer tool, I'm going to do a 10-year analysis. And my goal is to put my revenue growth numbers, my profit margin, free cash flow margin, my multiples, and my desired return to figure out what to pay for the stock today based on those numbers. Now, these assumptions can be anything you want. I tend to be more conservative. So even though Facebook has a 40% growth rate in revenue in the last 10 years, I don't think we can replicate that. Here's how. They do $120 billion in revenue last year. At 40% a year for the next 10 years, that would take them to $3.5 trillion in revenue. No company does even $1 trillion in revenue today. And I doubt Facebook will be $3.5 trillion in revenue. So I'm going to be conservative. Well, actually, here's what we're going to do. Let's look and see what the analysts are saying. The analysts are saying that in 10 years, they'll do $260 billion in revenue. That's about double, which is about 7% per year. 7% per year. Now, analysts tend to be a little bit more optimistic. So I'm going to make 7 my high side. Low side, 3, middle, 5. Profit margin. Now, profit margin might contract a little bit. Let's go 31. Let's go 29, 31, and I'm going to go 33%, just in case they manage to do some other things in the metaverse and really increase their margins, especially when they stop investing so much in the metaverse going forward. Free cash flow margin, I'm going to do the exact same thing, because over long periods of time, that should be the same. PE, I'm going to go 13, 15, and 17, which is currently higher than their current PE. And for my desired return, I'm going to do 12.5%. Why is that? Well, I tend to use 12.5%, especially on larger companies that understand how they generate business, because I want some sort of margin of safety. And if I could buy an ETF for 9 or 10% return a year, 12.5% is ample. I hit the analyze button. The company's currently at 175. Here are our numbers. We have a low of 150, a high of 260, and a middle number of around 195, 200. So this is where you stand. If you belong to our software, you can add a check mark, add it to your watch list, and pick any price you want. Maybe I pick 170. Notify me when it goes below 170. And that way I'm ready to do this. Thank you very much. If you like this video, don't forget to subscribe to the channel and check out everythingmoney.com to join our software.